What's up everybody, welcome back to my YouTube channel. I am Riza Ramzani, and this is Business Ideas. I am sure you all heard the news nowadays about all the fire happened in jungles of many countries that we know. The first and the most important thing we can do is that we all should give much more respect to nature and the earth and inform our younger generations. Okay, that's enough of bad news. Let's talk about today's video, which is about index fund and how it works. By the way, a like and subscribe to this channel would be amazing and it'd help us get more energy from you guys. Okay, let's start the video. What is an index fund? An index fund is a type of mutual fund whose holdings match or track a particular market index. It's hands-off, and you could build a diversified portfolio earning solid returns using mostly this type of investment. That's because index funds don't try to beat the market or earn higher returns compared with market averages. Instead, these funds try to be the market, buying stocks of every firm listed on an index to mirror the performance of the index as a whole. Index funds can help balance the risk in an investor's portfolio, as market swings tend to be less volatile across an index compared with individual stocks. What is an index? For investors, an index is a measure of the performance of the price of stocks, bonds, or other tradable assets in the wider securities market. When you hear newscasters talk about the ups and downs of the Dow, they are talking about how well a specific index, the Dow Jones Industrial Average, performed that day. As the name suggests, an index fund tracks a particular benchmark index. Some common benchmarks for index funds include index examples. The S&P 500. As noted above, Standard & Poor's 500 is an index of performance of the 500 largest U.S. public companies. The Dow Jones Industrial Average. This well-known index tracks the 30 largest U.S. firms. Nasdaq. The Nasdaq Composite tracks more than 3,000 technology-related companies. Russell 2000 Index tracks 2,000 smaller companies. The Wilshire 5000 Total Market Index. The Wilshire 5000 tracks the nearly 7,000 publicly traded U.S. companies, weighted by capitalization or market size. The MSCI EAFE Index tracks performance of large and mid-cap stocks of firms based in 21 developed nations outside the U.S. and Canada, including nations in Europe, Australasia, and the Far East. Do index funds have fees? Yes, index funds have fees, but they are generally much lower than competing products. Many index funds offer fees of less than 0.20%, whereas active funds often charge fees of over 1.00%. This difference in fees can have a large effect on investors' returns when compounded over long time frames. This is one of the main reasons why index funds have become such a popular investment option in recent years. Real-world example of index funds. Index funds have been around since the 1970s. The popularity of passive investing, the appeal of low fees, and a long-running bull market have combined to send them soaring in the 2010 seconds. For 2018, according to Morningstar Research, investors poured more than $458 billion into index funds across all asset classes. For the same period, actively managed funds experienced $301 billion in outflows. The one fund that started it all, founded by Vanguard chair John Bogle in 1976, remains one of the best for its overall long-term performance and low cost. The Vanguard 500 Index Fund has tracked the S&P 500 faithfully in composition and performance. It posts a one-year return of 7.37% versus the index's 7.51%. As of July 2020, for example, for its Admiral shares, the expense ratio is 0.04% and its minimum investment is $3,000. Things to consider when investing in index funds. As you're looking at index funds, you'll want to consider the following factors. Long-run performance. It's important to track the long-term performance of the index fund to see what your potential future returns might be. Each fund may track a different index or do better than another fund, and some indexes do better than others over time. Long-run performance is your best gauge to what you might expect in the future, but it's no guarantee either. Expense ratio. The expense ratio shows what you're paying for the fund's performance on an annual basis. For funds that track the same index, such as the S&P 500, it makes little sense to pay more than you have to. Other index funds may track indexes that have better long-term performance, potentially justifying a higher expense ratio. Trading costs. Some brokers offer very attractive prices when you're buying mutual funds, even more so than the same mutual fund company itself. If you're going with an ETF, virtually all major online brokers now allow you to trade without a commission. Also, if you're buying a mutual fund, beware of sales loads or commissions, which can easily lop off 1 or 2% of your money before it's invested. These are easy to avoid by choosing funds carefully, such as those from Vanguard and many others. Fund options. Not all brokers will offer all mutual funds, however, so you'll need to see whether your broker offers a specific fund family. In contrast, ETFs are typically available at all brokers because they're all traded on an exchange. Convenience. It may be a lot easier to go with a mutual fund that your broker offers on its platform rather than open a new brokerage account. But going with an ETF instead of a mutual fund may also allow you to sidestep this issue. Can an index fund investor lose everything? Putting money into any market-based investment such as stocks or bonds means that investors could lose it all if the company or government issuing the security runs into severe trouble. However, the situation is a bit different for index funds because they're often so diversified. An index fund usually owns at least dozens of securities and may own potentially hundreds of them, meaning that it's highly diversified. In the case of a stock index fund, for example, every stock would have to go to zero for the index fund, and thus the investor, to lose everything. So while it's theoretically possible to lose everything, it doesn't happen for standard funds. That said, an index fund could underperform and lose money for years, depending on what it's invested in. But the odds that an index fund loses everything are very low. Well, this is for today's video. I hope it helped you to have even better understanding about index funds. Thank you for watching the video. I will post new video every week. And don't forget to share this video with your friends.